When you hear about inflation, interest rates, or GDP numbers in the news, it might seem like abstract data that only economists care about. But in reality, these numbers directly impact your investments, whether you're in stocks, real estate, or even just saving money. Right now, the global economy is sending mixed signals, and understanding what they mean could be the difference between growing your wealth or falling behind. Let's start with inflation, one of the most important indicators. In early 2026, inflation had been gradually cooling towards central bank targets, with forecasts suggesting it could fall close to 2% by the end of the year. However, recent events have disrupted that trend. In the US, inflation recently jumped to around 3.3%, driven largely by rising energy prices due to geopolitical tensions. This sudden spike shows how fragile the inflation outlook still is and why markets remain uncertain. Why does this matter for investors? Because inflation erodes purchasing power and affects corporate profits. When inflation rises unexpectedly, companies face higher costs, and consumers spend less. This often leads to increased volatility in the stock market. At the same time, certain sectors, like energy and commodities, tend to benefit, which creates opportunities if you know where to look. Next, let's talk about interest rates. Central banks, like the Federal Reserve and the Bank of England, use interest rates to control inflation. Over the past year, rates have remained relatively high, but there's growing expectation that they may start to decline later in 2026 as inflation stabilizes. Some forecasts suggest rates could fall closer to 3% by the end of the year. However, the situation is far from straightforward. In the short term, rising inflation and geopolitical risks have forced central banks to stay cautious. For example, mortgage rates in the U.S. have recently climbed above 6%, putting pressure on the housing market and slowing home sales. This highlights an important point. Even small changes in interest rates can ripple across the entire economy. For investors, interest rates are critical because they influence asset prices. Higher rates tend to hurt growth stocks, especially in the tech sector, because future earnings become less valuable when discounted at higher rates. On the other hand, lower rates often boost equities and real estate by making borrowing cheaper and encouraging spending. Now let's look at economic growth. The global economy in 2026 is expected to grow, but at a slower pace than in previous years. In the UK, for example, growth has been sluggish, with some reports showing near flat expansion. At the same time, business confidence has dropped significantly, with companies focusing more on cost-cutting than expansion. This combination, moderate growth, uncertain inflation, and cautious businesses, creates what investors call a late-cycle environment. In this phase, markets often become more selective. Not all stocks rise together, and investors need to be more strategic about where they put their money. Another key factor is the labor market. While employment has remained relatively stable in some regions, there are signs of weakening beneath the surface. Slower hiring and rising unemployment expectations suggest that consumers may become more cautious with spending. Consumer spending strongly impacts corporate earnings and stock performance, making diversification essential. Spreading investments across stocks, bonds, and commodities helps reduce risk during uncertain times. It's also important to focus on high-quality companies with strong finances and pricing power. Keep an eye on interest rates. Falling rates may boost growth stocks, while persistent inflation can keep markets volatile. Most importantly, think long-term. Instead of reacting to short-term changes, build a portfolio that can handle different economic conditions.